Okay. I don't think I was live there for a moment. Again, I apologize. My name's Alexis Gallati. I just noticed that I wasn't live, and I'm just, like I was saying, I'm using new technology, so then that way I can present you with some visuals as well as seeing me. And so I apologize for that little blip there. Me and technology just don't mix. So, anyway. But we're here today to talk about my top three favorite changes when it comes to tax reform. This tax reform was the biggest one in 31 years. And of course, the main point of the entire bill was just to slash tax rates and to put more money into the Americans' pockets, basically. And there's also, other provisions as well that go in, helped pay for some of those dollars, So, which side of the aisle you sit on, it doesn't really matter. I just want to, inform you and show you, based on my experience and working with my clients, the things that I've seen that have just been amazing for saving all my clients across the board some money. And that's the whole point of working with me, is to help you keep your hard-earned dollars and get to put it back in your business, or spend it on a vacation, on a new car. You don't want us to give it to the IRS. You want to keep it yourself. So let's get started. Okay. Let me see again. Great. Okay, now PowerPoint. Okay, so hopefully now you should be able to see not only myself, but also my screen. Awesome, great. Okay. So the first slide that we're looking at is the lower tax brackets for individuals. And as you can see right off the bat, there's still 7 tax brackets, and they ascend from 10% all the way up to 39.6% in 2017. And for 2018, it starts again at 10%, and as you can see, the rate doesn't change, but each additional tax rate as you go up is actually lower than the prior year. So, for example, the next rate up in 2017 was 15%, and now it's going to be 12%. And bonus, not only did tax rates go down, but also the taxable amount of taxable income has increased. So, you can look at the very last line. For example, in 2017, you had 39.6%, and for a joint filer, it started at $470,000. Well, next year, or this year actually, for 2018, the top tax rate is 37%, and it doesn't start until $600,000. So that's a nice little bump up, and allows everyone to take advantage of some lower tax rates, and keep more of their money as well. So but the thing is that there were some deductions that were lost as well, due to these tax rates. And, some of them, include, you don't get personal exemptions anymore, but then that was kind of phased in together with, your itemized deductions. So, the standard deduction. So in 2017, it was $12,700, and 2018, it's going to be $24,000. So it effectively, what they did was they rolled together the exemptions and the standard deduction to just make a higher standard deduction, and now you no longer have any exemptions. And exemptions are what you get for, a certain dollar amount they get for yourself, for your kids, etc. So where someone might be hurt in that instance is if you have a lot of kids. And, kids are great tax deductions. I've always loved them. That's why I have 4 of them. Not just for that purpose, but it doesn't hurt. So The problem is, those with a lot of kids now don't get, I believe in 2017 it was like $4,050 per person, for exemption. And so obviously, if you have, four kids, 4 or 5 kids, and then, plus your, you and your spouse, that could be well over the, it's the standard deduction plus the rest of your exemptions. So, but one way that they kind of tried to help with that is they gave you an additional child tax credit. So instead of it being 1,000, it's 2,000 per child. And the what ended up happening with that too is they increased the income threshold for that. So I can't remember what it was for 2017, but I know it jumped up greatly to, I believe it's about 400,000 before your child tax credits phase out. So, and credits are a lot more valuable than deductions because they actually reduce your tax as opposed to just reducing your income. So deductions reduce income and credits reduce your tax. So let's look at an example real fast of how this might work out. Now, with this case study, you see it's a married individual with children. And I apologize, the bottom got cut off a little bit. But there's 2 children, and there's an adjusted gross income of $100,000. And you can see that for 2017, the standard deduction was $12,700, and they had itemized deductions of $24,000. And that assumes $12,000 of mortgage interest and $12,000 of property taxes. Now, one of the changes for 2018 as well was that you're limited to the amount of state and local income taxes including property taxes that you can deduct in a year. So to $10,000. So when you look at the 2018 column, you see that the standard deduction is now $24,000 and the itemized deductions are now $22,000 because that $12,000 of property taxes is now limited to $10,000. So the $10,000 property taxes plus the $12,000 of mortgage interest is the $22,000. So in 2018, the standard deduction is actually going to be a better option for this example couple. But as you go down, you can actually look and see that for 2017 versus 2018, the couple's tax rate went from 15% to 12%. So they saved, I didn't do the math before. I think it's about $1,300, 678, 4739. Yep, it's about $1,300. So, over 365 days, it's about $3.56 savings. It's nothing to scoff at. It's great. But definitely having these lower tax rates can open you up to more tax planning opportunities, which is something that I do with my firm, and being able to shift things around and seeing if we're able to find other deductions and credits and ways to shift money. And we're going to talk about that a little bit when we get to the business side of my favorite tax changes. But just for the overall person, I've seen in my own practice, I think like 99% of my clients saved money just with the change in the tax brackets. And so I'm really excited about that because I love helping my clients save money, but I can't take credit for it. It's the government that did it. So wish I could. But so let's look at my favorite tax reform change number 2, which is the lower corporate tax rates. Now, what's great about this is that there's so much more planning opportunities in general for businesses than with an individual just getting a W-2. And with this lower tax rate, what you can end up doing is playing around with the different types of entities and the tax rates. So let's go and take a look at what it looks like for 2017 versus 2018. Now, you'll look at the column for 2017, and there were eight different tax brackets when it came to corporate tax. And in the past, this was great because you could kind of play around with it a little bit if you want to have a corporation and, put up to $50,000 into there, you can have that come out at 15%, but obviously, as you get, more income, the higher the tax rate goes, like the old way it goes. So now for 2018, it's just a flat 21%. So it makes our calculations a lot easier. We don't have to remember all these different tax rates. And another great thing is for personal service companies. And personal service companies are businesses that provide a personal service. So you think about medical professionals, consultants, accountants, etc. The only people that that don't qualify as personal service anymore are engineers and architects. Somehow they lobbied enough to not be considered personal service companies, and which is great for them because there tends to be a lot more regulations around personal service companies. So in 2017, personal service companies were taxed at a flat 35%. Even if they only made $50,000 and they qualified for that 15% tax rate, too bad. They had to have the personal service company rate of 35%. Now it's 21%. So yay, everyone saves there. And this is really great because I work with a ton of personal service companies. My main concentration is with medical professionals, but I also work with consultants as well and engineers. So basically, it just creates such a great planning opportunity, not to only look at someone's tax entity, the way they're being taxed, but, in a moment, what I'll actually do is go through some examples of ways to save tax, by utilizing this corporate tax rate. And this is for C Corps, by the way, I want to mention. And then another great thing that went away was the corporate AMT. So just like individuals who have AMT, that was a great thing. I should have mentioned the AMT adjustment for individuals, actually our exemption amount went up. So a lot less people are actually going to be subject to AMT, and that's alternative minimum tax. And I could have a whole show just on, whole Facebook Live on just AMT, what it's about, and that's a great idea. I should probably do that. It's quite boring, so I'll have to make it fun. And so what we'll end up doing is I'll switch over now and talk about the ways that we can actually use these lower corporate rates to save on taxes. And one way you can do this is by, let's say you have an S Corp. You can actually portion out a part of your your income that is not directly related to the main service that you provide, and parcel that out and then put that into a C Corp and take advantage of the C Corp rates, as opposed to having your income subject or to the rates at your personal rates that pass through to an S Corp. And then what you can also end up doing too by having a C Corp is taking advantage of certain deductions that only C Corps can take advantage of, like deducting disability insurance. One problem though that you can have with having the C Corp and going and trying to keep your income in there is there's an accumulated earnings tax on amounts over $250,000. I believe that was not changed by the tax reform. If it was, if you could go and please let me know. But I can also double check that. But if the accumulated earnings tax is left if over $250,000 is left in the C Corp, it's subject to this accumulated earnings tax. But, don't despair. You can always keep it in there and give the IRS a reason why you need it in there, like buying equipment, for example. So, and the other thing you have to remember too is that with C Corps, there's double taxation. So you're taxed at the entity level, that 21%. And then if you want to get any money out, you have to take a dividend. And so that ends up being taxed at either 15% or 20%, depending on what your income level is on your personal return. This can be avoided. There are certain strategies, and like I said, could be a topic for a completely different show. But that's also too what I do best, and I would be able to help you figure that out. So let's take a really quick example. What it kind of looks like if you were to be a C Corp versus an S Corp. Now, I'm not saying you should just go out there and be a C Corp. It really, really depends on your personal situation. So let's look at this real fast. You have $250,000 of corporate income that you've received. And, if you look at the corporate column, you have an entity level tax of about $53,000. And so the remainder amount is going to be considered a dividend if you wanted to take the full amount out. And so what you can see at the very bottom is the total cash to owner with an S Corp. You actually, save about $40,000, get $40,000 more of the money you earn, even though if you look at the federal tax amount that you'd be paying, it's less. So I know that seems a little weird, but one thing that we'll also be discussing too, if you look in the S Corp column, which is a little preview to my number 3 favorite, this QBI deduction of 20%. So we'll discuss that in a moment. But my main point is you really have to look at the situations that you're at and your overall goals of your business to see whether or not the C Corp is a good idea for you, or if the S Corp is a good idea for you, or even just being a regular LLC, single member LLC, without having either of these elections. So contact your advisor if you want to contact me about it. If you have questions, please let me know. Okay, let's look at it. So number 3, I just kind of alluded to a little bit, is the qualified business income deduction. This is brand new. And basically what the government wanted to do was, they were lowering corporate taxes, but they needed some sort of mechanism to help those with pass-through entities. And so that would be, sole proprietorships, LLCs, partnerships, and S Corps. Any of those entities, they needed to, basically have some sort of equalization so that they save tax as well. Yes, you're saving on your individual taxes by the individual tax rates going down and the income thresholds going up, but there was still a big enough disparity where they had you do this qualified business income deduction. So what this is basically a new kind of income. The IRS likes to go and put certain types of incomes in different buckets, and in each of those buckets, they are taxed differently. The ordinary income rate is just your marginal tax rate, 15%, 12%, 37%. Investment taxes are going to be on things like interest, dividends, capital gains, etc. Passive income is so the investment income are taxed at like the 15%, 20% rate, and then also subject to the 3.8% net investment income tax as well, depending on if your income is high enough. So passive income would be income that you don't actively earn. So think about like a rental, for example. In most cases, unless you're a real estate professional, the passive income is going to be, you're not actively going out there to earn it. So you go and receive it passively. So now this qualified business income involves the income from different types of entities, and that will include, your net income from your Schedule C, trader business income from partnerships, trader business income from S corps, and that does not include W-2 wages or investment income from an S corp, real estate investment trust dividends, publicly traded partnership income, qualified agricultural co-op income. So those are kind of the definitions of the type of income that's available for this deduction. And the deduction is 20%. So let's say you have a small business and you're just a sole proprietor and you make $100,000 profit. Well, you get to take a deduction of 20%, so $20,000 off. So your actual taxable income on that amount is $80,000. So that's amazing. That's great. This deduction allows for so much more planning opportunities. I love it. It's just that's what's been great about this whole tax reform. There's just so many opportunities out there, and the tax plans I've been doing for my clients, it's been really fun to go and try all these different scenarios, and I've been able to save my clients tons and tons of money, and it's exciting when that happens. So going forward, there are some limitations, though, to that 20%, and that involves your the amount of income that you make. And we'll go over what those phase outs are in a moment over the next slide. But another thing, if you make over too much, then you have to go and take into account the amount that you earn in your W-2 and the amount of depreciable assets that are in your business. So there's a whole calculation. I could, again, do a whole show on just the QBI deduction, which, if people have interest on learning more about that, let me know. Any sort of topics you have, let me know in the comments, because that would be really great to know what sort of issues, or questions that you have or topics you'd like me to cover. So one issue too is with, again, service professionals, specified service businesses in general, like medical professionals, accountants, attorneys, consultants. Again, engineers and architects don't count. Anybody in those brackets don't get to take advantage of the deduction if they're over these certain amounts. So let's take a quick look. These phase out amounts, so the beginning phase out the beginning phase out for joint filers is $315,000. The phase out ends at $415,000. So essentially you end up losing, part of your 20% deduction as your income goes above the $315,000. And once it hits $415,000, you don't get the deduction at all if you're a service professional. If you're not a service professional, then let's say you have like a retail business, then that deduction is just subject to other limitations, which is limitations on how much your W-2 is and your amount of your depreciable assets. So make sure that you're keeping a really good track of your asset list. So then that way this deduction can be better utilized, and you can give it to your accountant at tax time. So there are definitely ways for service professionals to help mitigate this sort of damage, because it basically can prevent you from getting this great deduction. So again, I get asked constantly, doesn't that exclude high income earners? Well, no, not necessarily. Remember, it's on taxable income. So, you're taking all of your gross income, less your, adjustments to income, your itemized deductions, your, any other sort of expenses you have, etc., and that's your taxable income. So, even if you have over $500,000 of income, you can still find other deductions to lower it to below that 415 threshold. And like I was mentioning before, you lose about 15.12 cents approximately in per dollar for the deduction going between 315 and 415. But again, it's a perfect opportunity to do some tax planning. So some service business workarounds. Probably one of the best things to do is to really look at your business and see where you can sparse out or carve out what some non-service income. So think about, I work with a lot of medical professionals. So I have a chiropractor client who also sells retail products in his business. And so what you can end up doing is carving out the retail side of your business. So then that way, that any income that's associated with the retail business is not subject to the service business, the health part of the business, which is, them doing their chiropractic work. Another example would be, again, someone that is a dentist. And what you can end up doing is, anything that's health related, they can go and, that's obviously part of the personal service. And then another, you can take all the management, marketing, everything else that they do for the business and have another entity that takes care of the management portion of their business. So, you have to be careful to make sure that you're not, poking the bear basically and going to make the IRS mad. But if there's a legitimate reason to separate the two businesses so you can take advantage of that deduction, then, by all means, do it. And that brings to another fact where you're going and separating the businesses. You have the opportunity to choose different entities, or even, have multiple entities. So then that way you can take advantage of the deductions that one entity can have or the tax rates in another entity. And it's, like I said, it's really fun to be able to play around with things and make sure that you're maximizing your deductions. So, where do we kind of go from here with everything? I mean, there's a lot more tax changes when it comes to the tax reform. But we really can't cover it all right now in this such small period of time. Again, if you have anything that you'd like to, have me cover, let me know. But by this point, you've kind of seen where there's definitely some opportunities for tax planning. And so what I do in my business is I diagnose the problem, just like a doctor. And, I look at your tax returns, I look at your whole situation, and I prescribe a tax plan. These are the things that you should be doing in order to save yourself money. And then what we end up doing is implementing that plan and filling your prescription and just that, saving you money. On average, I saved my clients so far this year, on average about $20,000, for all the tax plans. That's on average. So, that's with just a little bit of tweaking, looking at things, and that's $20,000 a year, not just this year, per year. So over a 5-year period, that's $100,000. That's nothing to, sniff your nose at. So if you, are interested in contacting me about doing some tax planning, seeing how you might be able to take advantage of these sort of rates and changes, etc., I'd be more than happy to, speak with you about your return and your goals, and where you're going with your business. So it looks like we're about out of time, which is great because this is my last slide. So on our next Facebook Live, it'll be August 6th at 5 p.m. And in spirit of going back to school, we're going to talk about kids, which are an awesome tax savings opportunity. They are. There's so many things that you can do with kids, and to save money in your business, and talking more about the different tax changes that have occurred. I really look forward to talking to you guys more about it. And here, let me switch back. So yeah, great. Guys, I'm so excited to that you guys have taken the time to spend talking with me. And if you have any questions, I'm about to get off. Please ask right now. And if not, then I really look forward to talking with you again on August 16th at 5 p.m. Great. Thank you so much, guys.